Imagine walking into a strange land with almost nothing in your pocket. No connections, no fancy education, no resources. Yet within a single generation, your community controls billions of dollars worth of businesses. How did they do it? What secret did they know that others missed? This is not a fairy tale. It is the real story of the Patels. A group of immigrants who came to America with almost nothing. Within a few decades, they owned over half the motels in the country. Their secret is hidden in one simple word: Dhandho. But what exactly is Dhandho? Why does it turn the powerless into powerful? And how can its wisdom help you invest, build, and protect wealth in today's uncertain world? Stay with me. Because once you see the pattern, you will never look at business or investing the same way again. Let us begin with the story that started it all. The Patel Motel Dhandho. Chapter 1. Patel Motel Dhandho. When the Patels first arrived in America, their story looked like it was destined for struggle. Most of them came with little money, little knowledge of English, and no professional degrees. They had nothing that the world normally considers necessary for success. Yet, within one generation, this small immigrant community had taken control of a large part of the motel business in the United States. How was this possible? It began in the 1970s. Many small roadside motels were struggling. Large hotel chains were expanding aggressively, pushing older motels into decline. Many of these properties were available at dirt-cheap prices. Banks were often ready to lend because they wanted someone to keep the property running instead of shutting it down. To most Americans, buying these motels looked like a bad deal. To the Patels, it looked like opportunity. Here is what they did. A Patel family would buy a failing motel. The entire family would live in one room. They would run the front desk themselves, clean the rooms themselves, and even repair broken furniture themselves. This cut labor costs almost to zero. Expenses were controlled so tightly that the business had breathing space to recover. Soon the motel would start earning cash again. And when that first motel stabilized, another Patel relative would repeat the process in a different town. The risk looked big from the outside, but in reality it was small. If the motel failed completely, the Patel family would still have a roof over their heads because they lived in it. Their living costs were minimal. The downside was limited. The upside, however, was massive. A motel that once looked like a dead asset could become a steady source of income. This is the essence of Dhandho. Low risk with high potential reward. Or, in simple words, heads I win, tails I do not lose much. The Patels practiced this without ever reading a business textbook. They followed common sense. They bought cheap businesses that others had abandoned. They worked harder and smarter. They cut costs, reduced risks, and allowed upside to take care of itself. Within just a few decades, statistics showed that Patels owned more than half of all motels in America. This was not luck. This was not magic. This was the Dhandho Way in action. The strategy was so repeatable that it spread like wildfire within their community, from one family to another, from one state to another, from one generation to the next. The lesson for investors is clear. You do not need to invent something new. You do not need to be a genius. You only need to find distressed but functioning businesses that can be revived with frugality, discipline, and patience. The Patel Motel Dhandho teaches us that wealth is not built on chasing big risks, but on minimizing risk while keeping the doors of opportunity wide open. Now pause for a moment and think. If people with no resources, no networks, and no education could do this, what excuse do the rest of us have? If they could see an opportunity in a decaying motel, what opportunities might be hidden around us today? But the Patels are not the only example. Dhandho has been practiced by many individuals who had little at the start yet created enormous wealth. The next story is about one such man. His name is Manilal. His journey reflects the same principles in a deeply personal way. And it shows us that Dhandho is not limited to motels or hotels. It is a mindset, a way of living. Chapter 2. Manilal Dhandho. Manilal's story begins like that of many immigrants. He came to America with almost nothing in his pocket. He had no advanced degree. He did not come from a wealthy family. He did not have a powerful network to rely on. All he had was courage, frugality, and the willingness to work harder than most people around him. When he first arrived, the world did not welcome him with open arms. He took whatever work he could find. Small jobs that paid little but kept food on the table. He saved every dollar he could, refusing to waste money on luxuries. For years, his life was simple. Work, save, repeat. His friends laughed at his frugal lifestyle, but Manilal saw something that others missed. Every dollar saved was not just money in the bank, it was a seed for future opportunity. One day, that opportunity arrived. A small business came up for sale. The owner was tired, and the store was struggling. Most buyers were not interested. They saw a sinking ship. But Manilal saw something different. He saw a chance to apply the Dhandho principle. The price was low. The downside was limited. The upside could be huge if he was willing to put in the effort. He bought the business, but instead of hiring employees, he worked the store himself, often with his family by his side. He cut unnecessary expenses. He found creative ways to attract customers. Slowly, the business stabilized. Then it began to grow. What others saw as a dying shop turned into a steady income source under Manilal's hands. This was not a one-time event. Over the years, Manilal repeated the process. Buy small. Take limited risk. Work hard. Cut costs. Grow steadily. He expanded into other ventures, always keeping the same principle at heart. Heads I win. Tails I do not lose much. The beauty of Manilal's story is that he was not extraordinary in the traditional sense. He was not a genius inventor. He did not create a revolutionary product. He simply practiced discipline. He was frugal when others were careless. He was patient when others were restless. He was courageous when others were fearful. These are the true qualities of Dhandho. Manilal's journey teaches us that success does not require brilliance. It requires clarity and courage. Most people fail because they want quick results or because they are too scared to take even a small risk. Manilal did the opposite. He waited patiently. He saved aggressively. And when the right moment came, he was bold enough to act. For investors and entrepreneurs today, his story is a reminder that great wealth often begins with small steps. A struggling store, a failing motel, a business that others have abandoned. These are not signs of danger. They are invitations. If you are willing to live simply, work hard, and take small calculated risks, you can build something remarkable. Manilal did not just create wealth for himself. He created a foundation for his family. His children grew up with opportunities he never had. His sacrifices turned into their security. His discipline became their inheritance. That is the deeper meaning of Dhandho. It is not only about money, it is about building a path where the next generation can start ahead of where you began. Now think about this. If people like the Patels and Manilal could create such wealth without advanced knowledge or resources, what happens when this same principle is applied by entrepreneurs with vision and creativity? What happens when Dhandho thinking is used not only for survival, but for building new ventures? That brings us to a modern example. A man who built an empire by starting with one small plane and almost no risk. His name is Richard Branson. His story is called Virgin Dhandho. And it will show you how the same principle that worked for motels and small stores can also work in the glamorous and risky world of airlines. Chapter 3. Virgin Dhandho. When people think about Richard Branson, they often imagine a bold entrepreneur who takes huge risks. After all, he launched an airline, a record label, mobile services, and even space travel. But beneath the adventurous image lies a mind that deeply understands Dhandho principles. Branson's empire was not built on wild gambles. It was built on minimizing risk while keeping the door to huge rewards wide open. Take the story of Virgin Atlantic. In the early 1980s, Richard Branson was running Virgin Records. His company was successful in the music industry, but Branson was always looking for new challenges. One day, his flight to Puerto Rico was canceled. Annoyed, he decided to charter a small plane to get to his destination. He even sold tickets to other stranded passengers to cover the cost. In that moment, he saw an opportunity. Why not start an airline? Most people would think this was madness. Airlines are capital intensive. They require billions of dollars, thousands of employees, and carry enormous risks. But Branson's approach was different. Instead of buying planes, he leased them. More importantly, he negotiated with Boeing that if Virgin Atlantic failed, he could return the planes without penalty. This is the essence of Virgin Dhandho. Branson structured the deal so that if things went wrong, the downside was limited. He would lose a little money and some reputation, but not his entire fortune. On the other hand, if the airline succeeded, the upside would be massive. And succeed it did. Virgin Atlantic became a popular and profitable airline, challenging giants like British Airways. Branson used this same strategy again and again. Whether it was entering mobile services or launching retail businesses, he always looked for ways to protect the downside. He partnered with larger companies. He negotiated contracts that limited risk. He used his brand power to get favorable terms. Each venture was a calculated bet. Heads I win. Tails I do not lose much. The lesson for us is clear. Entrepreneurship is not about being reckless. It is about being creative in structuring deals. It is about asking the question, how do I enter this business so that if it fails, I do not get destroyed? And if it succeeds, the rewards are huge. This is Dhandho thinking applied to modern business. What makes Branson's story powerful is that it shows Dhandho works at every scale. For the Patels, it was buying small motels. For Manilal, it was running a struggling store. For Branson, it was starting an airline. The principles remain the same. Reduce the downside, protect yourself, and let the upside play out. Virgin Dhandho also shows that personality matters. Branson is adventurous, fun-loving, and willing to try unusual ideas. But behind the charm is discipline. He is not a gambler. He is a strategist. He knows that survival is more important than short-term glory. And because he survives every battle, he lives to fight the next one. For investors, the lesson is identical. Do not be seduced by hype. Instead, look for ways to structure your investments so that the downside is minimal. Buy cheap. Negotiate well. Keep flexibility. This way, even if 9 out of 10 ideas fail, the one success will cover all losses and bring enormous wealth. So far, we have seen Dhandho at the level of families and individual entrepreneurs. The Patels built an empire of motels. Manilal turned a small shop into financial security. Branson transformed an inconvenience at an airport into a global airline. But there is another story, one that operates at an even bigger scale. The story of a man who built the largest steel empire in the world using the same principles. His name is Lakshmi Mittal. His journey is called Motel Dhandho. Chapter 4. Motel Dhandho. Lakshmi Mittal is often described as the man who reshaped the global steel industry. From humble beginnings in India, he rose to become one of the richest men in the world. But what is more important than his wealth is the method he used to build it. At the heart of his empire is the same principle we have been exploring again and again. Dhandho. Mittal did not become rich by building brand new factories from scratch. That would have required billions of dollars, years of planning, and enormous risk. Instead, he looked for steel plants that were already operating but failing. Factories that others had abandoned. Companies that were drowning in debt. Industries that were in decline. To most people, these looked like hopeless situations. To Mittal, they looked like golden opportunities. His first big move came in Indonesia, where he bought a failing steel plant. The price was unbelievably low because no one else wanted it. But Mittal understood something simple. Steel is one of the most basic commodities in the world. It is used in buildings, cars, bridges, ships, and almost everything in modern life. Demand for steel would never disappear. The problem was not the industry itself. The problem was bad management and inefficiency. Mittal turned the plant around by focusing on costs. He streamlined operations, negotiated better deals, and cut waste. Slowly, the plant became profitable. Once he had proven the model, he repeated the process in many countries: Mexico, Kazakhstan, Romania. Each time, the story was the same. Buy distressed plants at bargain prices. Run them better. Extract profits. In 2006, Mittal made global headlines by taking over Arcelor, a European steel giant. It was the largest steel merger in history. Overnight, Mittal Steel became ArcelorMittal, the biggest steel company in the world. What is remarkable is that Mittal's empire was not built on massive innovation or risk-taking. It was built on the Dhandho principle: limited downside, huge upside. Let us break it down. When you buy an industry in distress, you pay a fraction of the replacement cost. If the plant succeeds, your returns are massive. If it fails, your losses are minimal because you bought it so cheaply. Heads I win. Tails I do not lose much. That is Mittal Dhandho in action. Mittal's story shows us that Dhandho can be scaled up to billions of dollars. The same principle that helped the Patels with motels and Manilal with a shop also helped Mittal build a global empire. The size of the business changes, but the logic remains timeless. For investors, the lesson is powerful. Look for industries that are out of favor. Look for businesses that others have given up on. Do not follow the crowd into hot trends. Instead, search for areas where fear has driven prices far below value. That is where the best opportunities lie. Mittal also teaches us about patience and courage. Buying distressed companies is not easy. You face criticism, you face uncertainty, you face resistance from competitors and governments. But if you remain focused on the fundamentals and keep your costs low, success will follow. So far, we have looked at individual stories. The Patels, Manilal, Branson, Mittal. Each of them shows how Dhandho works in real life. But now it is time to step back. To put all these lessons into a clear framework. A map that anyone can follow. The next chapter is where Mohnish Pabrai gives us the blueprint of Dhandho. He takes the stories and converts them into a framework that investors can apply directly. This is where Dhandho stops being just inspiring and starts becoming practical. Chapter 5. The Dhandho Framework. Up until now, we have seen Dhandho through stories. The Patels buying failing motels. Manilal turning a struggling shop into security. Richard Branson leasing planes instead of buying them. Lakshmi Mittal building a global steel empire from distressed factories. These are powerful examples. But to truly use Dhandho in our own lives, we need more than stories. We need a framework. A set of guiding principles. Mohnish Pabrai calls this the Dhandho Framework. At its heart lies one timeless idea: minimize the downside, maximize the upside. This is not theory. It is a mindset, a way of looking at opportunities. Let us break it down step by step. First, Dhandho teaches us to invest in existing businesses. The Patels did not invent motels. They bought motels that were already built but failing. Mittal did not invent steel. He bought plants that already existed. Richard Branson did not invent airplanes. He leased them. Why waste time and money creating from scratch when something is already out there at a discount? Second, Dhandho focuses on simplicity. Businesses that are too complex are hard to understand. If you cannot explain how a company makes money in a few sentences, you probably should not invest in it. The Patels understood motels. Manilal understood retail shops. Mittal understood steel. These are simple, clear businesses. Third, Dhandho looks for distress. When fear takes over an industry, prices fall below value. That is when bargains appear. Fear creates opportunity. The brave investor steps in when everyone else is running away. Fourth, Dhandho emphasizes moats. A moat is a durable competitive advantage that protects a business from competitors. It could be brand power, cost advantages, or customer loyalty. If you buy a business with a moat at a low price, your chances of success multiply. Fifth, Dhandho is about making few but big bets. Instead of spreading yourself thin across hundreds of ideas, wait patiently for rare opportunities. When you find one, bet heavily. This is how fortunes are made. Sixth, Dhandho loves arbitrage. Arbitrage is when you find a price gap between value and cost. It might be hidden in distressed industries, failing businesses, or overlooked markets. Arbitrage is everywhere if you train your eyes to see it. Seventh, Dhandho insists on margin of safety. Always buy at a discount. Always give yourself room for error. This way, even if you are wrong, you do not lose much. And if you are right, the profits can be extraordinary. Finally, Dhandho looks for uncertainty but low risk. This is important. Many investors confuse uncertainty with risk. A business might have uncertain short-term results, but its long-term survival may be safe. If you can buy such a business cheap, you can profit greatly. When all these principles come together, you get the Dhandho framework. It is not complicated. It is simple. Buy existing businesses. Keep it simple. Look for distress. Favor moats. Bet rarely but boldly. Exploit arbitrage. Always demand margin of safety. Seek low-risk, high-uncertainty opportunities. Think about this. If an immigrant family with no money could use this mindset to dominate the motel industry, what can you do with it? If Mittal could use it to build the largest steel empire in the world, what doors could it open for you? But theory alone is not enough. To make the framework real, we must dive into the details. Each part of the framework becomes a lesson. A rule you can follow in your own investing. And that is exactly what comes next. Chapter 6. Dhandho. 101. Invest in existing businesses. When we think of business success, most people imagine inventors creating something brand new. They imagine Silicon Valley startups, billion-dollar ideas, and revolutionary products. But the truth is, most new businesses fail. Statistics show that the majority of startups do not survive beyond the first few years. The reason is simple. Building from zero is extremely risky. You need to create demand, build infrastructure, hire people, and burn through cash before profit appears. Very few manage to survive this battlefield. Dhandho tells us to flip this thinking upside down. Instead of starting from scratch, invest in businesses that already exist. These businesses already have a customer base. They already have a product or service that works. They already have a reputation, even if it is damaged. And often, they are available at a fraction of their true worth, because the current owner is tired, bankrupt, or mismanaging it. Think back to the Patels with their motels. They did not build new hotels from the ground up. They bought motels that were already there but failing. They did not have to construct rooms, create signage, or build plumbing systems. All of that was already in place. All they had to do was operate efficiently and cut unnecessary costs. The result was instant cash flow. Mohnish Pabrai emphasizes this point with investing as well. Why gamble on a brand new company with an untested product when you can buy into an existing business at the right price? Existing businesses have track records. They have numbers you can study. You can analyze years of financial reports and see how the company performs in good times and in bad. This makes your decision more grounded in reality and less based on hope. Another advantage of investing in existing businesses is speed. Startups can take years to prove themselves, but if you buy into an already running business, you can see results almost immediately. For example, when Warren Buffett bought See's Candies, he was not creating a chocolate company from nothing. He was buying into an existing brand with loyal customers. His job was simply to manage it better and let its natural strength compound wealth over time. The Dhandho mindset says, do not be a pioneer in every battle. Be a settler. Let others make mistakes, struggle, and prove the idea. Then you step in, take over, and scale it safely. This is why investing in existing businesses creates a much higher probability of success. Now imagine two people. One decides to start a new restaurant with a unique cuisine no one has tried before. He spends money on designing menus, advertising, and hoping people show up. Another person buys an existing restaurant that already has steady foot traffic but poor management. He improves service, reduces waste, and keeps the loyal customer base happy. Who do you think will have better odds of success? The answer is obvious. Investors and entrepreneurs must learn to respect this truth. Do not always chase the thrill of being the first. The world rewards those who are smart enough to see working systems and take them over at the right price. But buying existing businesses is not enough. There is another filter that makes the Dhandho Way stronger. The business must also be simple, because complexity is the enemy of clarity. And that takes us to the next chapter. Chapter 7, Dhandho 102, Invest in Simple Businesses. One of the biggest mistakes investors make is falling in love with complexity. They get excited about cutting-edge technology, complicated financial products, or new scientific breakthroughs. These things may look attractive, but they are hard to understand, and when you do not fully understand a business, you cannot predict its future with confidence. The Dhandho Way tells us to keep things simple. Simplicity is power. A business that you can explain to a 10-year-old is usually the kind of business worth considering. If you cannot describe how a company makes money in 1 or 2 sentences, then it may be too complex to invest in. Think about a gas station. It makes money by selling fuel to drivers. The customer demand is easy to understand. The risks are straightforward. You know that people will continue driving cars for many years. Now compare that to a biotech startup creating a new kind of medicine. The science is complicated. The approval process is unpredictable. The risks are enormous. One mistake and the whole investment can collapse. Which one fits the Dhandho approach better? Clearly the simple one. Warren Buffett has said many times that he avoids businesses he does not understand. This is why he stayed away from most technology companies for decades. Instead, he invested in Coca-Cola, American Express, and newspapers. Simple businesses. Products that people used every day. Business models that were easy to grasp. As Buffett puts it, you do not have to swing at every pitch. You just have to wait for the one you understand. Simple businesses also make it easier to spot problems. If a motel's occupancy rate is falling, you can quickly find out why. Maybe service quality dropped. Maybe competition increased. These are issues you can fix. But if a high-tech company suddenly loses market share, it might be due to reasons you cannot even begin to measure, like new patents, changing algorithms, or complex technological shifts. For the ordinary investor, simplicity is not a weakness. It is protection. It reduces the chance of surprises, and it makes you confident in your decisions. When you understand a business completely, you can invest boldly. Now imagine this. You have 2 doors. Behind one door is a simple business, perhaps a small retail store with predictable income. Behind the other door is a high-tech company with exciting potential but unknown risks. The Dhandho investor always opens the first door. Because when you understand something fully, you can see the downside clearly and calculate if it is acceptable. But there is another powerful twist to this idea. Sometimes, even simple businesses fall into deep trouble. Entire industries go through crises. Prices crash. Investors run away in fear. These moments look dangerous, but for the patient and disciplined investor, they may be golden opportunities. Because when simple businesses become distressed, they can be bought at a fraction of their true value. This is the next level of Dhandho. To not only invest in simple businesses, but to look for them when they are in pain. That is where the largest fortunes are made. Chapter 8, Dhandho 201. Invest in distressed businesses in distressed industries. Every few years, entire industries go through cycles of boom and bust. Prices rise too high, greed takes over, and then a sudden downturn wipes out confidence. In these times, the crowd runs away. Businesses sell at throwaway prices. To most people, this looks like danger. But to the Dhandho investor, this is the perfect hunting ground. Think about the airline industry after the September 11th attacks. Passenger demand collapsed. Airline stocks fell to historic lows. Many investors sold in panic, believing the industry would never recover. Yet within a few years, air travel was back to normal. Those who had the courage to buy during the crisis made fortunes. The principle is simple. When the entire industry is distressed, the prices of businesses often fall far below their true long-term value. Lakshmi Mittal, the steel magnate, followed this exact playbook. Instead of building new factories, he looked for steel plants that were shutting down or losing money. He bought them for pennies on the dollar. By managing them better and waiting for the industry to recover, he created one of the largest steel empires in the world. The risk looked big, but in reality it was limited. The assets were cheap. The upside was enormous once demand returned. The Dhandho principle here is, heads I win, tails I do not lose much. In distressed industries, prices are already beaten down. This means the downside is often already priced in. If things get slightly better, the returns can be extraordinary. But if things get worse, the loss is usually not devastating because you entered at such a low cost. History offers many such examples. Oil companies during an oil price crash. Banks during a financial crisis. Real estate after a housing bubble bursts. Each time, fear drives prices below reason. For the disciplined investor, fear creates opportunity. But caution is important. Not every distressed business will recover. Some are broken permanently. The trick is to separate the temporary from the terminal. For example, if an industry is facing a short-term shock, recovery is likely. But if new technology has destroyed the business model forever, then it may never come back. The Dhandho investor must carefully study the difference. Imagine you are walking through a marketplace. Every seller is shouting in fear, trying to get rid of their goods at any price. Would you walk away, or would you calmly pick up valuable items at a discount? Most people panic and run. The Dhandho Way says, this is the exact moment when you should be paying attention. However, buying cheap is not enough. Once the industry recovers, competitors will fight for profits again. To truly succeed, you must look for businesses that not only survive distress, but also have the strength to defend themselves when conditions improve. In other words, you must look for companies with durable moats. That is the next step in our journey. Chapter 9. Dhandho. 202. Invest in businesses with durable moats. Imagine a castle in ancient times. The walls are high. The gates are guarded. But the most powerful defense is the moat, a deep trench of water surrounding the castle, making it nearly impossible for enemies to attack. In business, a moat represents the same idea. It is the competitive advantage that protects a company from rivals and allows it to earn profits year after year. A business without a moat is like an open field. Anyone can come in and compete. Prices fall, profits disappear, and the business struggles to survive. But a business with a strong moat can defend its profits, even when competitors try to attack. The Dhandho investor understands that buying distressed businesses is powerful, but the best opportunities come when those businesses also have durable moats. So what does a moat look like in real life? Take Coca-Cola. Its recipe is not impossible to copy, but the brand itself is so powerful that customers reach for a Coke without thinking twice. That brand loyalty is a moat. Another example is American Express. Its network of cardholders and merchants creates a self-reinforcing system. The more people use it, the more merchants accept it. The more merchants accept it, the more people want to use it. This network effect is a moat. Durable moats can take many forms. They may be strong brand identity. They may be low-cost operations that competitors cannot match. They may be patents or exclusive rights. They may be switching costs that make it painful for customers to move to another product. Whatever the form, the moat protects the company's long-term ability to make money. Now imagine combining the two Dhandho ideas. You buy a distressed business in a distressed industry. But this particular company also has a moat that others cannot easily break. The price you pay is low because of temporary troubles, but the company's defense system ensures that once the storm passes, it will return to profitability and keep competitors away. This combination creates explosive returns with minimal risk. Warren Buffett often reminds us that time is the friend of a wonderful business and the enemy of a mediocre one. A durable moat allows compounding to work its magic. Without a moat, even a great-looking business will eventually collapse under pressure from competition. But here is the challenge. Moats are rare, and even when you find them, they are not always permanent. Technology can destroy them. Consumer habits can change. A moat today might be a weakness tomorrow. That is why the Dhandho investor must stay alert, always questioning whether the moat is truly durable. This is where judgment and patience play a role. You cannot buy every business. You must choose carefully. You must wait for the rare opportunity when a business with a durable moat becomes available at a distressed price. And when that moment comes, you must be ready to strike. This brings us to the next principle of Dhandho. Chapter 10, Dhandho 301. Few bets, big bets, infrequent bets. In life and in investing, most people believe safety comes from spreading their resources as widely as possible. They are taught that diversification is the golden rule. Put a little here, put a little there, and somehow the risk disappears. But Mohnish Pabrai argues that this is not the Dhandho way. In fact, true wealth is rarely created by holding 100 small positions. It is created by placing very few bets, betting big when the odds are in your favor, and waiting patiently until the next rare opportunity comes along. Think about how the Patels bought motels. They did not buy every business available. They focused only on one type of business they understood deeply. Then they put everything into making it work. That is concentration. That is focus. And it worked. The same idea runs through the history of the world's greatest investors. Warren Buffett calls it the idea of waiting for the fat pitch. Imagine standing at the plate in baseball. The average player feels the pressure to swing at every ball. But Buffett says an investor can wait forever. There is no penalty for standing still. You can wait until the perfect ball comes at the perfect speed, right into your strike zone. Then you swing with full force. That single hit can change the game. The Dhandho principle tells us to do exactly that. Do not spread yourself thin. Do not bet on every stock or every business that looks attractive. Instead, wait until you find something that is not just good, but overwhelmingly good. When you find a business that has limited downside and massive upside, when the price is absurdly lower than its true value, that is the time to go big. But here is the second part of the principle. These opportunities do not come every week or every month. They may come only once a year, or once in several years. Patience is the secret weapon of the Dhandho investor. Infrequent bets mean you must be comfortable doing nothing for long periods. Most people cannot do this. They want constant action. They want the thrill of trading. But constant activity often destroys wealth. Few bets, big bets, infrequent bets. This is not gambling. It is the opposite. Gambling means betting big without knowing the odds. Dhandho means betting big only when the odds are stacked overwhelmingly in your favor. It is like finding a coin that is 90% likely to land on heads. If you see that coin, you do not just place a small bet. You bet as much as you can, but only when that coin is in front of you. Mohnish Pabrai himself followed this rule. He modeled his fund after Warren Buffett's partnership. Instead of holding dozens of random stocks, he looked for a handful of opportunities where the value was undeniable. When he found them, he concentrated heavily. The result was outsized returns without unnecessary risk. The lesson here is also psychological. To follow Dhandho 301, you must fight against human nature. You must fight the urge to always be busy. You must accept boredom. You must accept long stretches where nothing seems to happen. But when the right chance comes, you act decisively. This chapter is a reminder that investing is not about constant motion. It is about selective, powerful strikes. Wealth is built not by doing more, but by doing less with greater intensity. And yet, there is another angle to this story. While waiting for those few opportunities, how do you recognize them? How do you measure the difference between an ordinary situation and a once-in-a-decade chance? The answer lies in the art of arbitrage. Understanding how to fixate on price gaps that are almost guaranteed to close. This takes us directly into the next idea of the Dhandho framework. Chapter 11, Dhandho. 302. Fixate on arbitrage. Imagine buying something for $1 and being almost certain you can sell it tomorrow for $2. That is arbitrage. In the world of finance, arbitrage means exploiting gaps in pricing. The Dhandho investor is always on the lookout for such situations because they carry little risk and offer high certainty of reward. Now, arbitrage is not always as obvious as buying cheap in one market and selling high in another. Sometimes it takes the form of recognizing mispriced businesses. A company may be trading at a price far below its real worth because the market is temporarily fearful or distracted. If you can clearly see the gap between price and value, you have found an arbitrage. Let us take an example. When Richard Branson leased his first airplane to start Virgin Airlines, he made a deal with Boeing. If the airline failed, Boeing would take the plane back. What Branson created was a kind of business arbitrage. The downside was limited because the risk of owning the plane was removed. The upside was massive if the airline succeeded. He fixed the game in his favor by structuring the deal. That is arbitrage thinking. The Patel Motel strategy was also a form of arbitrage. They bought motels at distressed prices, often financed by banks eager to avoid foreclosure. The families lived in the property, reducing living costs to nearly zero. Competitors saw danger, but the Patels saw a clear gap. They paid a fraction of the value, worked hard to restore operations, and pocketed the gains. This was not speculation. It was a calculated play on a mispricing. In investing, arbitrage often appears during times of crisis. Stock markets are emotional machines. When panic spreads, prices can fall far below the true value of businesses. A patient Dhandho investor steps in during such times, buying quality assets at fire sale prices. It is almost like buying winter coats in summer, when nobody wants them, and selling them in winter when demand returns. But arbitrage is not limited to obvious bargains. It also exists in differences across geography and time. For instance, a steel company may be undervalued in one country's market compared to another. Or a business might be worth more in the future than it is today because investors are blinded by temporary issues. The Dhandho Way is to fixate on such situations. Study them deeply. When you find one with near certain payoff, act decisively. Here is the key insight. Arbitrage is about reducing risk, not increasing it. Many people think investing is gambling, but arbitrage proves the opposite. It shows that by thinking differently, by looking where others do not, you can design investments where the downside is minimal and the upside is almost guaranteed. This is the purest expression of heads I win, tails I do not lose much. However, finding arbitrage opportunities requires discipline. They are rare. They often appear only in moments of chaos, and they demand the courage to go against the crowd. Most people run away when prices collapse. The Dhandho investor runs toward them. This is not blind bravery. It is rational courage, backed by logic and careful study. As we move deeper into the Dhandho framework, one truth becomes clear. Even the best arbitrage deal can fail if you overpay. No matter how good the opportunity looks, you must always leave room for error. This is where another timeless principle enters the picture. It is called the margin of safety. Without it, even the smartest arbitrage can turn into disaster. With it, you protect yourself from the unknown. Chapter 12. Dhandho, 4 out of 1. Margin of safety. Always. Imagine you are crossing a bridge that can hold exactly 5 tons of weight. Your car weighs 4.9 tons. Would you risk driving across? Probably not. The numbers say it might hold. But what if the bridge is weaker than advertised? What if there is hidden damage? The risk is enormous because there is no room for error. This is why engineers and builders always include a margin of safety. They design the bridge to carry 10 tons, even if the expected load is only 5. That cushion protects against the unknown. In investing, the same rule applies. The margin of safety is the gap between what you pay and what something is really worth. If you believe a business is worth $100 a share, you should not buy it for $95. You should buy it for $50 or $60. This discount gives you protection if your calculations are wrong or if unexpected events occur. The bigger the cushion, the safer your investment. Benjamin Graham, the father of value investing, made the margin of safety the central pillar of his philosophy. Warren Buffett followed the same path, and Mohnish Pabrai adopted it into the Dhandho framework. Without a margin of safety, even the smartest analysis can collapse under pressure. With it, you can be wrong and still avoid disaster. Think again about the Patel Motel strategy. They bought motels at deeply discounted prices, often paying far less than replacement cost. Even if business was slow, the price they paid was so low that survival was almost guaranteed. That discount was their margin of safety. It protected them from total loss while giving them time to turn things around. The same logic applies to stocks and businesses. Markets are unpredictable. Even the best companies face unexpected challenges: new competitors, regulatory changes, recessions, or scandals. No one can predict these perfectly. The only defense is to buy so cheaply that the unknown cannot wipe you out. That is why Pabrai insists that Dhandho investors must always demand a wide margin of safety. Now here is where many people get confused. They think margin of safety means lower returns. In truth, it often means higher returns. Why? Because buying cheap not only reduces your risk, but also increases your upside. If you buy a business worth 100 for 50, you double your money when the market corrects. You are both safer and richer. Safety and profits are not enemies. They are partners. But here is the challenge: having the discipline to wait. Most investors are eager. They see prices close to fair value and want to jump in. They fear missing out. The Dhandho investor must resist this temptation. You do not settle for almost safe. You wait for undeniable safety. This patience separates the average from the exceptional. Think of it as hunting. If you are hungry, you may feel tempted to shoot at every shadow. But the wise hunter waits for the perfect shot: clear, close, and certain. Margin of safety is that perfect shot. It ensures that when you act, you do not just survive, you thrive. As powerful as this principle is, there is more to the Dhandho mindset. Sometimes opportunities come disguised as chaos. Businesses may look broken, industries may look hopeless, and uncertainty may be sky high. To most people, these look like traps. But for the Dhandho investor, they may hide the richest opportunities of all. This is where we explore the difference between risk and uncertainty. Chapter 13, Dhandho. 402. Invest in low-risk, high-uncertainty businesses. Most people think that uncertainty is the same as risk. If a business faces unpredictable events, they assume it is dangerous. But Mohnish Pabrai teaches us to see the difference. Risk is when your downside is large. Uncertainty is when the outcome is unclear. A Dhandho investor seeks opportunities where uncertainty is high, but risk is low. This is where the greatest profits are made. Imagine a company operating in an industry that is struggling. The headlines scream fear. Everyone avoids it. The price falls sharply. The business seems risky because the future is uncertain. But what if the company has a strong balance sheet, loyal customers, and a low-cost structure? What if even in the worst case, the business will survive without losing much? The risk is actually small. The market only sees uncertainty, not real danger. This is the essence of low-risk, high-uncertainty investing. The Dhandho investor thrives where others panic. The key is understanding the fundamentals. Study the business. Calculate the downside. Ensure that even if everything goes wrong, the losses will be limited. Once this is certain, uncertainty becomes an opportunity rather than a threat. Let us return to the Patel Motel example. Many motels were located on highways that seemed doomed because new routes were being built. Competitors closed down. Prices of these motels collapsed. For most people, it was a warning. For the Patels, it was a chance. By living frugally inside the motel, managing costs tightly, and leveraging their family labor, they reduced risk to almost zero. The uncertainty of the location or industry did not threaten their survival. Instead, it amplified potential gains when demand returned. This strategy also works in the stock market. A distressed company in a struggling industry may trade at a fraction of its intrinsic value. Investors who ignore panic and focus on true downside protection can buy at enormous discounts. Even if the business faces challenges, the small risk limits potential loss. When the market recovers, the upside can be huge. Psychology plays a critical role here. Most investors flee from uncertainty because fear dominates decision-making. But fear and greed are opposites. The Dhandho investor uses fear as a signal. high uncertainty often indicates mispricing. When the crowd panics, opportunity appears. Recognizing this requires courage and discipline, not speculation. Another important aspect is patience. Low-risk, high-uncertainty opportunities are rare and irregular. The market does not always provide them. A Dhandho investor must wait quietly, doing nothing until the right chance emerges. Acting too early or too late can destroy potential. Timing is critical. Finally, this approach connects naturally to the next Dhandho principle. Once you understand risk versus uncertainty, you begin to see why copying proven models is safer than betting on untested innovations. Innovation carries unknown risks that cannot be calculated, whereas a well-tested model with uncertainty can be mastered. Chapter 14. Dhandho. 403. Invest in the copycats rather than the innovators. When most people think of success in business, they imagine the genius innovator, the person who invents a revolutionary product, the one who disrupts entire industries. Innovation is glamorous. It captures headlines. It excites investors. But Mohnish Pabrai teaches a counterintuitive truth. The true path to consistent wealth often lies with the copycats, not the innovators. Why? Because innovators take enormous risks. They spend millions developing products that may fail. They experiment in untested markets. They are vulnerable to competition, market rejection, or technological obsolescence. For every Steve Jobs or Elon Musk, there are hundreds who fail quietly and disappear. Betting on innovation is like gambling on an unknown outcome. Copycats, on the other hand, do not face these risks. They observe what works. They replicate proven business models. They often improve operational efficiency, scale faster, or expand geographically. Their strategy reduces uncertainty and limits downside while still providing significant upside. Dhandho investors love this combination: low risk, high potential gain. Think of McDonald's. They did not invent fast food. They copied a small hamburger stand and perfected the process. They standardized operations, created consistency, and scaled globally. The innovators who came before them faced failure or stagnation. McDonald's became a global empire. The lesson is simple. Betting on proven models is safer, more predictable, and highly profitable. The stock market offers similar examples. Companies that replicate successful strategies often outperform risky new ventures. Investors who identify these copycats can buy them at attractive valuations and ride the wave of growth. This is especially powerful when combined with the principles of low risk, high uncertainty investing, and margin of safety. You are not chasing untested ideas. You are leveraging what has already been validated. Copycat investing also aligns perfectly with another Dhandho principle: simplicity. Simple businesses with proven models are easier to understand, analyze, and manage. There are no hidden technological complexities or unpredictable market shifts. This allows investors to estimate value more accurately, calculate downside risk, and focus on long-term upside. However, success requires patience and observation. Not every copycat is worth investing in. Many fail because they are poorly executed, over-leveraged, or enter saturated markets. The Dhandho investor studies carefully. They look for businesses that are efficiently run, have a sustainable moat, and operate in industries where proven strategies dominate. Psychologically, this approach is also easier to stick with. You are not constantly chasing novelty. You are following evidence. You are replicating success. This reduces emotional mistakes and impulsive decisions. The strategy rewards discipline over bravado, analysis over luck, and patience over impulsiveness. Finally, this chapter naturally leads us to the next critical principle. Buying is only half the journey. Selling at the right time is equally important. When do you exit a successful investment? How do you balance gains with ongoing risk? These are the dilemmas faced by investors once they follow the copycat strategy. And this is what we explore in the next chapter. Chapter 15. Abhimanyu's Dilemma: The Art of Selling. Buying a business can feel exhilarating. You find an undervalued company, analyze its numbers, see the potential, and imagine the upside. But the real challenge often begins after you own it. Selling a business, or knowing when to sell an investment, is one of the hardest decisions an investor can face. This is what Mohnish Pabrai calls Abhimanyu's dilemma. Just like the warrior Abhimanyu in the Mahabharata, who entered a complex battlefield he did not fully know how to exit, investors often enter investments without a clear exit plan. Abhimanyu's dilemma is about timing and emotion. The moment you own a business or stock, your mind begins to attach to it. You imagine all the profits you could make if you hold on. You feel the excitement of watching its value rise. But this emotional attachment can cloud judgment. The most common mistakes are selling too early or selling too late. Sell too early and you leave significant gains on the table. Sell too late and you risk losing hard-earned profits when circumstances change. Pabrai teaches that the key to solving this dilemma lies in preparation. Before buying, an investor must ask, under what conditions would I sell? This could be when the business reaches fair value, when the moat erodes, or when market conditions change drastically. By defining exit criteria in advance, you remove emotion from the decision. You know exactly when to exit. Abhimanyu did not have a map to exit the battlefield. Investors who plan have a clear exit strategy. Another aspect of selling is patience. Often, businesses take time to realize their full potential. Early in the journey, small fluctuations in value may tempt an investor to sell. But a Dhandho investor understands that wealth is built slowly, by allowing investments to compound over time. Only when the underlying fundamentals change, or the business no longer fits your investment framework, should you consider selling. Abhimanyu's dilemma also highlights the importance of focus. Investors frequently watch too many stocks, analyze every news update, and react impulsively. This distracts from the few bets that truly matter. Instead, focus on your high-conviction investments. Define your rules, stick to them, and resist the urge to interfere unnecessarily. Selling should be deliberate, not reactive. Finally, the chapter emphasizes learning from experience. Every sale, whether profitable or not, teaches lessons. Did you exit too soon or too late? Did fear or greed influence your decision? Over time, these lessons sharpen judgment, helping you navigate future dilemmas with greater clarity. Selling is not just about money. It is about discipline, patience, and the art of decision-making. In essence, Abhimanyu's dilemma is a warning and a guide. It reminds investors that buying is only half the journey. Wealth is protected and realized through smart exits. By planning, focusing, and learning from experience, you can master the art of selling. This naturally leads to the next question. Should you even try to beat the market consistently, or is it safer to follow the index? Pabrai addresses this in the next chapter. The decision to index or actively invest depends on your skill, patience, and understanding of Dhandho principles. Chapter 16. To index or not to index? That is the question. Investing in the stock market is often portrayed as a battle. Some people try to pick winners and outperform the market. Others take a simpler route and invest in index funds, which mirror the overall market. Mohnish Pabrai asks a simple but profound question. Should you try to beat the market, or is it wiser to follow the index? The answer depends on skill, patience, and understanding of Dhandho principles. For most investors, indexing is a safe and effective strategy. It removes the stress of trying to pick the next winning stock. By investing in the overall market, you are guaranteed to earn market returns without the need to constantly monitor businesses or react to news. It works because the market rewards long-term investors. Historical data shows that, over time, index funds consistently grow and provide wealth to patient investors. However, Pabrai argues that for those who understand Dhandho, there is an opportunity to do better than the market. Dhandho investors look for situations where risk is limited, but the upside is large. They focus on simple businesses, distressed assets, and undervalued opportunities. When the odds are heavily in their favor, these investors can place few, big, and calculated bets. If done correctly, these concentrated investments can outperform the market by a wide margin. The challenge is that this path is not for everyone. Most investors do not have the patience, discipline, or analytical skill to identify these opportunities. Without proper understanding, attempting to beat the market can lead to losses and frustration. The Dhandho approach requires deep focus, a clear exit strategy, and emotional discipline. One must be willing to sit patiently while others panic, and act decisively when rare opportunities appear. Pabrai also emphasizes that the decision to index or actively invest is personal. Some may choose indexing for peace of mind and steady growth. Others may embrace the challenge of active investing to capture extraordinary returns. Both paths are valid, as long as the investor is aware of the trade-offs, limitations, and risks involved. Finally, this chapter connects to the essence of focus. Just as Arjuna, the great warrior, could target only the eye of the bird and ignore distractions, investors must identify opportunities that fit their skills and temperament. Whether you index or actively pick investments, your success depends on clarity, concentration, and consistency. This naturally leads to the final lesson in the book. How can we learn from Arjuna's focus to become better investors? The next chapter shows us that true investing is not about knowledge alone. It is about vision, discipline, and the ability to ignore noise while aiming precisely at the opportunities that matter most. Chapter 17. Arjuna's Focus. Investing Lessons from a Great Warrior. In the Mahabharata, Arjuna was one of the greatest warriors of his time. When he aimed his arrow at a target, he did not see the forest, the trees, or the distractions around him. He focused only on the eye of the bird. That single-minded focus allowed him to hit targets that others could not. Mohnish Pabrai draws a powerful investing lesson from this ancient story. Successful investing requires the same clarity, discipline, and unwavering focus. Arjuna's focus teaches us that the mind is easily distracted. In the world of investing, distractions come in many forms. News headlines, daily market fluctuations, rumors, and opinions of others can cloud judgment. Most investors react to these distractions, buying and selling impulsively. This is the opposite of Dhandho thinking. A Dhandho investor studies the business, understands its intrinsic value, and acts only when the opportunity meets strict criteria. The rest is noise. Focus also means patience. Arjuna did not release his arrow prematurely. Similarly, investors must wait for the right opportunity. Opportunities that fit the Dhandho framework, low risk, high potential upside, are rare. When they appear, decisive action is required, but only after thorough analysis. Most of the time, a Dhandho investor sits patiently, observing, learning, and preparing. Patience amplifies results when the right moment finally arrives. Another lesson from Arjuna is about preparation. Before the battle, Arjuna trained rigorously, understanding his bow, arrow, and environment. Likewise, investors must understand the businesses they invest in. They must know the competitive landscape, financials, and risks. Preparation reduces uncertainty and increases the odds of success. Luck plays a minor role when preparation and focus are strong. Arjuna's focus also teaches the importance of ignoring irrelevant data. Investors often obsess over minor details that do not affect the long-term outcome. A Dhandho investor filters the noise and concentrates only on what matters: margin of safety, business fundamentals, and upside potential. By doing so, they avoid unnecessary stress and make better decisions. Finally, Arjuna's example emphasizes courage. The warrior faced life and death battles without hesitation. In investing, courage is required to act against the crowd, to buy when others are fearful, and to hold when others panic. Without courage, opportunities are missed. Without focus, wealth cannot compound over time. In conclusion, Arjuna's focus embodies the spirit of the Dhandho investor. Clear vision, patience, preparation, courage, and the ability to ignore distractions are the pillars of successful investing. By applying these lessons, anyone can navigate the complex world of markets and businesses with confidence. The journey of investing is not about being busy, it is about being focused. Not about doing everything, it is about doing the right things. Not about reacting, it is about acting wisely. With Arjuna's lessons, the Dhandho framework comes full circle. From Patel Motels to distressed businesses, from simple investments to rare big bets, the principles remain consistent. Minimize risk, maximize upside. Stay disciplined, stay patient, and above all, focus like a warrior. The Dhandho Investor is not born overnight. But by studying these stories, applying these lessons, and cultivating focus, anyone can develop the mindset to build wealth steadily, wisely, and safely. If you enjoyed this journey through the Dhandho Investor and want to learn more strategies to minimize risk, maximize rewards, and think like a Dhandho investor, make sure to subscribe to the channel. By subscribing, you will get more insights, story-based lessons, and practical investing tips delivered straight to you. Don't miss the chance to strengthen your financial knowledge and build wealth wisely. Hit the subscribe button now and join our community of smart, disciplined investors.